There's very few people who've taken even one company from zero to a $1 billion plus public exit, and he had done it multiple times across categories and
Melody is like porn.
changed a public perception of his sexiness as more of an output problem than an input problem. Even in that hype era that you're kind of alluding to, we were still price disciplined on the tech side. It's like, how much effort have you put into this thing? If you look at like someone's average phone, they probably have like 50 or 100 apps and probably use like 4 of them on a daily basis.
Hi, I'm Mike Gelb, and this is Consumer VC, where we discuss what it takes to invest in and build scalable consumer businesses. A big thank you to Odile for introducing me to our guest today, Shamin Walsh, who is the managing director at BAM Ventures. BAM is an early-stage, consumer-focused venture capital firm based in LA. They've backed some of the truly iconic consumer companies: Cotopaxi, NerdWallet, Zola, Away, Thrive Market, Honey. The list goes on. Seriously, some of the most exciting consumer businesses and success stories out there. In this episode, we dig into what it actually means to invest at the pre-seed stage and how BAM thinks about its fund size today and where they're headed. Also, how they balance investing across consumer brands, consumer tech, and commerce enablement. But before we jump in, I want to tell you about Highbeam. Highbeam is the all-in-one finance platform built specifically for consumer brands. If you're running a D2C or omnichannel brand, you know managing cash, payouts, inventory, and vendors isn't just back office work, it's core to the business. Most banking platforms weren't built for that. Highbeam combines no-fee banking, automated treasury to maximize yield on idle cash, flexible credit, bill pay, and live 13-week cash flow. Plus, AI agents that automate tedious manual spreadsheet work. Think fast answers to ad hoc sales and finance questions, cash flow forecasting and scenario modeling, benchmarking, and much, much, much more. Brands like Bird Dogs, New York or Nowhere, Ridge, and Avocado use Highbeam to stay on top of their finances and scale without hiring a full team. Build your brand, keep your cash. Head to highbeam.co to sign up. That's highbeam.co. Also, sign up today for a free 3-month trial of their AI analyst. And lastly, a quick disclaimer: all content on this show is for informational and entertainment purposes only. Nothing here should be considered investment advice. Now let's get to it. Here's Shamin. Shamin, thank you so much for coming on the show. How are you?
I'm good. Thank you for having me. I was just saying how it's been nice to meet you in different contexts, and you've moderated a panel I was on, and we did that group lunch, but I have yet to see you in your space, so it's cool to be here.
No, I really appreciate you coming on. Yeah, we met through Odile, right? And then started off with the lunch, and then of course we also did a panel together. And now you're here. This is
Yeah,
wonderful.
look at that.
So let's start from the very beginning of your BAM journey. What made you decide to join?
So prior to BAM, I worked at a small early stage fund in LA. Our differentiator was that we owned tangible assets like 3PL fulfillment logistics. And I had done all the consumer sourcing there and kind of run the day to day because I'd had a great deal flow network. I'd been angel investing for years. I had the privilege of being one of the first investors in Sweetgreen. And thankfully, based on how well they had done, other great founders knew other great founders. And so the BAM guys were one of the first folks I had met when I started in venture. We had ended up investing in a lot of deals together. A good example is Thrive Market, where they were the very first investors. They had so strong in consumer, and then we had our 3PL and logistics background, and so it was very synergistic in that way. That fund performed really well, but they wanted to go even deeper into logistics and more majority stake private equity type. And I wanted to stay in an early stage consumer. I just love consumer and starting at the earliest phase. And there's no one that I know that does it better than the BAM folks. And one thing that had particularly been helpful is that we'd been on a board together. So it wasn't just, sharing deals, socializing, but you kind of like were in the trenches with them. And then, of course, Brian's credibility as an entrepreneur. I mean, there's very few people who've taken even one company from zero to a $1 billion plus public exit, and he had done it multiple times across categories, and just he loved the earliest stages of consumer, and So did I, and it was just the perfect fit. So, yeah, I joined in 2017. We've always been equal partners, which is kind of like revolutionary at the time. I feel like it's revolutionary even today, sadly. And we raised Fund 2 together, Fund 3 together, and then now we're at the very tail end of raising Fund 4. So we'll probably unlock that later this year.
Amazing, amazing. What made the BAM folks so special when you met them, or and also when you work with them?
I think that there is a true look, venture is risky as is. No matter what category you're in, there's always a level of speculation when you're investing in anything around its future potential and growth. But I think that there's a lot of folks that feel a particular way, and rightly so, about consumer in the sense that there's a lot of touchy feeliness around it, or it's like more of an art than a science. And um, coincidentally, totally irrelevant to our careers now, but Brian and I are both lawyers by background, and it reminds me of this law school case where they asked about the definition of pornography, and the judge couldn't really articulate it. He's just like, "You'll know it when you see it." And I feel like pre-seed consumer is very similar. There are, at the stage we invest, sometimes you have some metrics, but maybe not a lot. Like, there's not a lot of, like, quantifiable, like, XYZ you can point to as to why you think something will be great, and the VAM guys, Brian did it, and he wasn't afraid of it, and he's also really good at it, and he's also created it. So, there's really no one else I could imagine wanting to work with that, um, both got it themselves, but was able to create it as well.
No, that's a really no, I really do appreciate that. It actually reminds me a little bit just from what you said about pornography. I had this music teacher who said melody is like porn. You can't describe it, but you kind of know it or hear it when you kind of know what it is once you see it. So very very cool. What I mean, consumer's also really challenging though, right? Really, I mean, it's not quite, even though it's really sexy on one level, because it is, it is products, it is, things that we touch, it's things that we buy. From an investment perspective, it's not very sexy though. It's kind of been left in the dust for quite a few years. What is exciting to you about consumer and consumer startups, and what was your original attraction to consumer?
That's a really good I think what you're saying articulates a lot of what folks have been saying in the market in general. But I think for us, consumer has always been sexy, which is why we've been doing it across 4 funds for the past 10 years. Because I think what has changed a public perception of the sexiness is more of an output problem than an input problem. So, sure, consumer, is not sexy if you define it only as consumer brand and you can only have a $10 billion outcome. Then maybe it's not the right category for you if you're, $1 billion, multi-billion-dollar fund, and like that's the parameter you're going after. Your pool of opportunity is extremely limited. But there are many, 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 hundreds of acquisitions a year and for 300 million, 500 million, sub-billion just on the brand side alone. Then, of course, you have the once in a lifetime generational type companies that, people define as the 5 largest companies in the world, like 3, 4 out of the 5 are consumer companies, which are, do come once every 10, 15, 20 years, definitively. But between those 2, there's still been a lot happening in consumer, and for us as a $50 million fund who writes initial checks very early on, we're primed to return venture-like returns, whether this company exits for 300 million or, $30 billion. And I think when you put a target on consumers back because you expect every company to have the same kind of come as Apple or Facebook. Sure, they are consumer tech, but if you expect that to happen on a recurring annual basis, then of course. Um, but I don't think that's a category problem. I think that's just people taking outlier examples and now wanting everything to be that.
Do you think you can still get achieve power law type returns in consumer?
Of course. I mean, I've used this example in other podcasts and I have multiple examples that are like this. But I mentioned, we were early investors in Pretty Litter. They only raised 1.5 million. They've exited for north of 500 million. And that was, 70, 80x. Like that was power law return type. And that was just on the brand side. And then we're investors in Honey, which is, over a 360x return for us. Like you can definitely get that. But again, it depends on when you invest, how much they end up raising. You look at the capital stack, what they exit for. You don't necessarily need to have a multi-billion-dollar outcome, but you do if you've raised $1 billion. You do if you've invested at a $300 million valuation. So again, like we're not talking about enough about the inputs, but the outputs are there. It's just a hard category for a lot of folks that are deploying a lot of capital because, even going back to that Pretty Litter example, if you're a large fund, a company that's only raising 1.5 million might never even come across your radar or not even be worth your time.
Right. It's just not meaningful enough. And it's not really going to, if you have such a large fund as well, it's that is actually not going to maybe make a dent in terms of the actually ROI that you need to drive across, if you have $1 billion fund, let's say.
Yeah, and again, that's not a category problem, that's just like a matchup problem. And by the way, like there's nothing wrong with those funds strategies. Again, it's like a puzzle piece. Like these two pieces may not fit together, something else may fit with them. Doesn't mean that anyone else's strategy doesn't work, but it's not the category itself that's flawed or that has changed or that doesn't have outcomes because how could that possibly be true if 70% of GDP is still, run by consumers. How can that be possible if we've had like the largest Black Friday sale, last year or, that we're not becoming any more well known as a country or culture for becoming massive savers. Like we're spending money and we're spending money somewhere, but we're, how we spend it, how we spend our time, how we spend our money may be shifting, but the spend is still there and the opportunities are still there.
Is it a good thing that consumer maybe is underappreciated though in the venture community?
It's good for me. Yeah.
Yeah, good for you. Yeah.
Yeah,
Um,
absolutely.
how so the current fund 3, you said it was $50 million, right?
Yes.
Is that right? $50 million fund. How I know that you're about to kind of lock up fund 4. How do you think about fund size overall? And in terms of, because I'd imagine in consumer, well, I've talked this before with different investors, but I mean, in anything, your fund size is your overall strategy, right? In
Yeah,
terms of how big your fund is. In consumer, it seems like you have to be pretty disciplined in terms
right.
of in terms of how big the fund size is. So what is how do you think about, fund 4, fund 5, fund 6, for example, how big you want those funds to be in order to be able to execute the strategy that you want to execute when it comes to investing in consumer?
Yeah. Um, so Fund 4 will be $5 billion. I'm just kidding. Fund 3 is $50 million. Fund 4 is $50 million. Fund 5 will be $50 million. I mean, this
Wow.
is the strategy. Um, it's funny because I often feel when you have a smaller fund, people think it's like a stepping stone to a larger size, and it would actually have been much easier to raise a larger fund because your pool of capital is more limited.
Expands. Yeah.
Yeah, and so it would have been, and especially with Ryan's credibility and our past track record, it would have been so much easier. But there are, again, back to this is a great category if you have the right infrastructure and setup for it. We want to be able to see founders who don't need to raise necessarily tons of money. And maybe they're building a multi-billion-dollar business that necessitates it, and that's fine. But we don't want to invest in founders who have to take in a lot of money because we're saying to them, well, we're X size, and so you have to take this $20 million check, or else this investment like isn't worth it for us. Like we want to be as aligned with our founders and our LPs as possible, where we're defining our success by performance and returns and not from management fees. I mean, the main downside of our fund size is obviously management fees. But other than that, I mean, We're as close to the founder journey as an investor can be. We're as close to like LP performance base as an investor can be. And we're all just kind of in the same boat together. And I think, there are a lot of different factors specific to our fund strategy and our fund size that contribute to, why we have continued to have successes over the past 4 funds because even, in the grand scheme of the world, even going from 50 to 100 million, for example, doesn't necessarily sound like a lot when there are billions and multi-billion dollar funds, but it completely shifts your strategy. The amount of capital you have to deploy completely changes. And, we're particularly strong in a certain aspect. So, like, why would we try to change what we're good at if what we're doing is working?
How do you think about investing? Because you kind of have three different buckets of categories that you invest in, right? Brands, commerce infrastructure, and consumer tech. How do you balance kind of how many brands, for example, commerce infrastructure and consumer tech companies you invest in across your e- uh, across each fund?
Those categories um, they don't have quotas or like check the box, like, okay, if we do 50 companies, X amount is this and X amount is that. We're very founder driven. We've always been founder driven. So we kind of back into it as, okay, these are the three categories where we feel like we can help you accelerate a potential competitive advantage, either based on what we've been focusing on for the past 10 years or have built ourselves. Like, this is where we think, you know, we can actually have a piece of knowledge that we can stand behind. Other than that, it's completely founder driven. So we look at all, but we have um, one fund may be slightly more brand driven than the other. Another one may be slightly more tech driven than the other, and it's really just a function of the founders and and what we've come across.
What then do you look for when you have a first meeting with a founder?
We spend a lot of time trying to understand who founders are just as people. Like, what's motivating them to start this business? Are they doing this for the glory? Or are they doing this to have a title? Do they find it glamorous to be a CEO or not? Their ability to attract talent. How much are they doing this where it's their thing as opposed to they're building something bigger than themselves? We're looking at someone who has kind of an eagle eye lens on different consumer behaviors. Perhaps they have unlocked a super fan community that, you know, that's already been pretty saturated. Um, so for example, let's say everyone's looking at sports, but no one's doing anything in power sports. And we meet a founder who comes from that world and loves that world and building a marketplace for their people like in the power sports space. So the going deep in certain particular categories where that audience is not just fickle, but what you're building is speaking to something that they can have an emotional connection with. And I think most importantly, that kind of ties in all of these things is a founder who truly understands how their customer behaves and knows how they behave. So, I'll tell you, sometimes it's easier for me to articulate what I'm not looking for. I think there's a lot of really smart people out there that are building things that would be amazing in a vacuum or in a perfect world, but like people do not operate necessarily rationally or in a perfect world. So, for example, if you're meeting someone who is building a multi step logging platform that, if adhered to perfectly, will give you the most optimized way to track all of your macros, but it only works if you are diligent and meticulous about how you're doing it. Yeah, like, if I did this perfectly right, I would love that, but, you know, that's not how we work, And then you might think, "Wow, if used perfectly, this was amazing, but I only inputted 30% of it in," or, you know, I've only used it for 2 days, and then I think the product sucks, and it's like, it's not a product problem, it's just the fact that this founder didn't truly understand how a person's mind work and actually how hard it is to change behavioral change and, like, how you really have to lead a consumer a certain way to to either connect with them or to get them to trust you or to convert that sale.
What's an example of a company? It could be a company you invested in, or or it could be a company that you just really admire that you think have done a really good job in that in terms of making a new consumer behavior, but also was kind of in lockstep in terms of educating the consumer about the product.
I think Thrive Market's a really good example in the sense that, when Nick was first raising, and BAM was the very first investor in the company. And when Nick was first raising, a lot of people didn't get the concept because it was during a time in which Amazon, well, Amazon is still Amazon, but like it was at a time where people thought, I don't get it. You're curating these, like, healthy foods at memberships prices, and you're offering them this convenience and XYZ, but, like, I could find all of these things on Amazon. Like, how does this compete with Amazon? Like, I could literally find the same exact peanut butter or whatever it is anywhere else. And he was a really good example to us of someone who understands consumer behavior or, like, how the consumer mind works. And, he didn't try to necessarily say, become defensive and be like, "No, you couldn't," or like, "This is how it." He was like, "You're absolutely right. You can find this on Amazon." But that necessitates a level of consumer intent that most people don't have. So if, at that time it was, really at the beginning of certain um food regimes for folks like, Whole30, Paleo, Keto, etc. And whichever philosophy you followed, I may know that it's something I want to try out. I can tell you if I wanted to try out something, I would have no idea where to even start on Amazon. So it's like, sure, if I knew I wanted a particular product, I don't even, I can go and try to search for it. But in terms of feeling like I can be guided through a particular experience, that I feel like there's a community around it, it's one of the brands that had the earliest use that I'm aware of like true authority influencers, with Mark Sisson and others like within like the actual leaders of particular regimes saying, participating with it and getting involved with the company and helping like, curate for folks. And to have a platform where if you're XYZ and I don't even need to think about it, like I can trust it. I know that they've done all the hard work of like the label reading and the sourcing, and I can just go paleo and know that every product there is safe. Like just freeing up that mind share. That's the kind of thing you look for in a founder. It's not something tangible in terms of, oh, you're offering ghee, how great. It's, like, not about the particulars, it's about somebody who understands that people wanna be healthy, people wanna free up mind share, and, like, these are the things that matter, and that's the kind of thinking that helps differentiate great founders for us.
Yeah, no, that's a great example with so Thrive Market, part of the value prop to consumers was trust. Trust in recommendations, trust in the actual curation of the products and alignment in terms of what your values are as a consumer in food. We actually have the exact same values, so you don't have to go spend a lot more time finding the right products.
Absolutely.
Makes sense. You brought up kind of a couple examples on the physical brands side of it, where a company might raise, you know, $1 million or $2 million, but then that might be the first and last fundraise,
Yep,
and you can achieve venture like returns because it's hopefully in like a $300 million, $500 million type exit. And of course, the founder's really happy. You all are really happy. It's really just a win-win all around, right? And then you also have like I'm thinking like commerce infrastructure, which is kind of interesting from the way I see it. And I'm curious about you. We've we've seen some funds that started off investing in physical brands, and then as they become bigger, I think kind of shifted towards investing into commerce infrastructure type companies because typically these outcomes from a venture perspective are a lot larger just on paper, the valuations from a valuation perspective. My point being, how do you think about reserves as well when it comes to investing in these companies? Because you obviously have the upfront investment when it comes to a physical brand or a commerce infrastructure company or a consumer tech company. I would say consumer tech probably is more in the bucket of like commerce infrastructure in terms of what those outcomes could be. Um, how do you think about initial deployment and then how much you should actually reserve in capital for pro rata?
That's a really good question and a good point. We typically invest 500K pre-seed seed, and we're pretty valuation disciplined, so we're very early. Um, if we invest in a brand, it's typically sub 10 posts, but the ideal sweet spot is around that like $5 or $6 million mark. And if we're investing in tech, if we think that there is truly the opportunity for a much larger outcome, because you're always playing this like math trade-off game between larger outcome or dilution. There are very rare examples. I can't even think of one off the top of my head where someone only needs $1 million and also is building a $10 billion company. So like traditionally, there's like this kind of like trade-off. And so if you think the math continues to math, we can go a little bit later with tech up to 15 posts, so not even that much later. Um, but the way we think about it is initially 500K check size, and then we'll follow on with, up to 1 million potentially in, seed or our on A's. So we don't write initial checks in A's. Um, Traditionally, I'd say about a third of the portfolio will probably get some level of follow on. And then we don't invest beyond the Series A. And we have a lot of later stage funds that are investors in our funds. We have really strong relationships with other funds and growth funds. So nobody is starting from scratch after a BAM check. But in terms of BAM, to your point, we're trying to concentrate our check size and attention at the earliest stages where we can get the most juice out of the squeeze for like our dollars.
It seems like when it comes to price discipline in this market, it's nothing's easy. I'm not saying it's easy, but it's much easier to stay price disciplined in this market than it was let's call it 2018 to 2022. During the 2018-2022 years, how were you able to stay price disciplined?
I think it's a function of having done it for, as a fund, we've been around since 2014. Brian has been building companies since 1999. I invested in Sweetgreen in 2007. I think we've just seen a lot of markets and it's hard for sure, but the opportunities are there and it helps a lot to cut out the noise and just focus on what matters. So even in that hype era that you're kind of alluding to, we were still price disciplined even then because we knew the numbers weren't going to math out. And also, when we looked at some of our biggest successes from BAM 1, which is, a 2014 fund, it mimicked the same strategy we have now, which is invest early and invest at this valuation. And you could see the difference. I mean, we had a couple of portfolios in BAM 1 that had, from a PR perspective, had an incredible outcome, multi-billion dollar or public or whatever, and it made money and it looked good, but when you looked at, like, dollar for dollar what went back to LPs, you realize it's not just a logo game if you're seriously in this for the upside. So I think that's how we stay price discipline is having the benefit of looking on actual use cases and really just looking at actual numbers.
Were you able to still win deals, for example, while remaining price disciplined, where other investors, for example, were happy to pay, a higher price for the same company?
I think you're always gonna miss out on stuff. I think we benefited on winning from deals again because of how early we invest, and then I
Mhm.
think a lot of founders really valued Brian's entrepreneurial experience as well, because not only has he built multiple successive businesses, but for us, like we consider it a core strength that Brian is an active CEO because the same kind of strategies that help LegalZoom become successful in 99 is not what's making Arena Club successful today. You didn't have even the same types of channels back then. And so I think founders really liked um, working with a fund where they truly believe that our journey is aligned with theirs. And I think, this idea of being founder friendly is so overused that it like has completely diminished its meaning whatsoever. But I can say just from a testament of like how many of our founders become LPs after um, you know, great exits. Or, you know, I feel confident that if you talk to any of our founders, they will tell you themselves like what a role we've played with them. And so I think that kind of investment in long-term relationship building and just kind of doing what we're going to do and sticking to a category and just having this institutional knowledge like compound on each other and staying active in this space is oftentimes more valuable than other things. And then keep in mind, given our check sizes, sometimes founders are willing to they're not as concerned because they're not taking in so much where the valuation conversation, we're not like, "Hey, take $3 million at a $5 million valuation," right? It's like not so much money that it's a hard conversation to have necessarily.
Got it. I know, you know, Bam, I know you look for companies that make dollars before they make sense. How do you, and, kind of alluding to as well, companies that are really capital efficient. How do you think about capital efficiency in today's landscape? And do you think capital efficiency at all has evolved?
I think capital efficiency again, I think this is an input and output question. So I think capital efficiency may not matter as much if you're an incredible fundraiser and you're building something that has a multi-billion-dollar outcome. So, look at something like Uber, right? They've raised a ton of money but all of their early investors also made a ton of money and it wasn't even designed to be capital efficient from day one. So I don't think it's necessarily this hard and fast rule where you have to be capital efficient. I think it's if you're not capital efficient, are you an amazing fundraiser? And if you're an amazing fundraiser, are you an amazing operator that's going to build this once in a lifetime defining consumer technology type business? And if so, I have that conviction, then okay, then that's part of your strategy and it's an intentional part of your strategy. And some founders have that strategy. But I think if it's a particular category where you're not capital efficient, but you could easily be capital efficient, or if, you know, there's not enough of an outcome there where, if you're trading in a category that typically gets acquired for a 1x revenue multiple, and then you're not capital efficient and you've raised, $100 million to have a $200 million exit, then that's again, the numbers aren't working. And so I think we're not so black and white where we say, if you're not profitable, no way. Because I think you can miss out on a lot of those like once in a generation type businesses if you look at things that way. So um we're not um sticklers in that sense. But to your question, of course things have changed. Once folks found out that, there were certain outcomes that were more the exception than the rule, and realized that there were a lot of companies that may have been attractive with a different set of inputs, but weren't attractive with the ways that they had been funded or with the way they had been run. Then they realized, hey, you know, we actually need like solid unit economics from the ground up because everybody got stuck in a position where they were waiting on the next round to justify this company's existence, and that next round didn't come, and then what happened? That company didn't have an infrastructure to sustain itself. So I think, we don't wanna be in the business of investing in companies that necessarily rely on the next venture round for their existence without unless they truly are going to become that, like, once in a lifetime, potentially generationally defining business, and those are very few and far between.
when you meet with a company, do you actually talk and you're actually thinking about making investment even at the, I mean, of course, at kind of like the pre-seed level. Do you do you talk about future fundraising in terms of what their like trajectory, what they're thinking about doing from on the equity side or not really?
Yeah, of course. They always want to talk to us about it because, we have a really close relationship with our founders because we're often, as I mentioned, the earliest investors. And the earliest investors are often the folks that saw something in you before you became hot and cool. And so it builds a level of goodwill or trust that, you're aligned in terms of like wanting the best for the company or that you don't only like them because they're the new flashy, hot, cool thing. And founders always come and talk to us about it. They talk about, I could go this path or that path. And we just talk it through. Okay, if you want to go that path, you have to be X amount bigger. And if you want to do that, then great. Like you should. But just know like how the bar changes as you make those different, like at those different inflection points.
What type of I know that, at this stage you're betting a lot on the founder, betting everything on the founder. But what do you have to see maybe from a traction perspective or from a metric perspective in the early stage to make you curious or make you think they of course might not have gotten product market fit at this point, but make there's certainly maybe signs that there might be that they're on their way.
Transparently, we don't invest very often pre-launch. If we do, it really depends on the founder and having had potentially a pre-existing relationship with the founder. Um, and if we are investing in something that has launched, the numbers don't have to be large. They just need to necessarily be indicative of something. So if we can see enough to see, whether it's a consumer social app and we can get a sense of, how many hours people are spending inside it, how they're sharing it with others, are they downloading it, what like how it's changing their behavior around it. Even if your numbers are small, we can get a sense that like you've gotten a super fan cohort. And then if it's a physical good, same thing, just thinking about, returns, repeat purchase rate, and then benchmarking that against industry averages and thinking about, you know, like, what is a typical cadence for this type of product? Like, how often are people buying skincare? And if people are, bought a cleanser, and then we see 2 months later they're also buying a moisturizer and a serum, and then we see that they've started to subscribe, like that's more indicative of and more meaningful for us than to say, I had a million purchasers day one. Because I think part of what makes consumer difficult is that you can sometimes have a false positive and false signaling. You could have a lot of early excitement about something like a sellout inventory drop or everybody downloads this consumer app today. And then a month later, 2 months later, a year later, etc., they've moved on to the next thing. And so that's that's what we're like really trying to distill is like how much of this behavior is sticky, so to speak.
Yeah, it's what's separation between a fad and a trend, right? So what are I guess it's really hard, right? Because if a company is growing really quickly and you see like a lot of user engagement, a lot of downloads, a lot of time spent on, let's say, an app, or even if it's a consumer product, a lot of kind of really high velocities, let's call it. How do you how to measure if something if you think something is maybe temporary or something is actually could be long lasting?
I think different categories have different I think it's always hard, but I think different categories have different degrees of difficulty. So for example, I think consumer social is particularly hard. Um But again, if Brian was an early investor in Snap. So if you invest in, a consumer social platform that becomes one of the once in a generation platforms, like that's amazing. But I think we understand, like we have a higher bar for identifying certain companies than others because the barrier, like it's like it's way less friction to download something for free that you can just easily also delete, that you don't have to put a lot of effort into using, that may just have entertainment, nice to have value versus a utility, for example. When you look at on the app space, for example, if you look at like someone's average phone, they probably have like 50 or 100 apps and probably use like four of them on a daily basis. Actually, like you can tell me, like, what apps are you using on your phone, like every day, or you're like, I need to use this app?
I use Slack.
Utility?
Utility, exactly. Gmail, also utility.
Probably.
My Fitness Pal, Perplexity, uh, ChatGPT. Um,
So those are all utilities.
yeah, utilities. Spotify,
Okay.
um,
Now we're in entertainment.
and entertainment.
But, like, Spotify was really clever because they created playlists that you put in. You have to put effort into making your playlist, and then it disappears if you unsubscribe. So, that's pretty sticky.
That is pretty sticky. Yeah, no, for sure, for
But
sure.
you put work into it, right? So that's something we look at. Like, when we let's say, like, because I know we've talked about brand a lot, like, on the tech side, it's like, how much effort have you put into this thing? And you've probably put a lot of effort into your Spotify at this point, because if you get rid of it, you have to start all over.
I think just like anything, ease of use. You just know it, and it just becomes a habit, and you know exactly where the songs you want to play are. I haven't been as good, I'll be honest, at making playlists. I just use a search function like crazy, and but um, but yeah, I mean, like, I know, like, it now knows, like, all the podcasts I listen to, so it just kind of just comes up quite frequently, and also kind of pings me when there's a new episode or something. So it's just really just like anything. I'm just kind of like a creature of habit,
Yeah.
just from using it. So yeah,
Okay, that makes
yeah,
sense.
yeah. But that's a great point. But also YouTube. I I took off TikTok on my phone. I used to be on TikTok, but I just like once I start, I feel like it's just then like 20-30 minutes
Abnormal?
down. Yeah,
Yeah.
exactly. Then it's like 20-30 minutes go down, even an hour, and I just I can't do it. But yeah, how about you?
Where's my phone? Oh, I don't think I've ever done this with anyone before.
Yeah, it's kind of a fun exercise.
Yeah, okay, so I have my browsers, I have, like, my kids monitor, all the cable streaming ones like Peacock and Hulu and
Yep,
what
I have
have
all
you,
that too. Hmm.
Pandora and Spotify, the preschool, like, payment system, LinkedIn, Starbucks, my airlines,
Yep.
um,
Wallet, I'd imagine.
wallet, um, and then news, like AP,
Okay.
um, and then, yeah, I have Facebook, Instagram, and TikTok.
Yeah. Yeah.
But, like, tell me this, how many apps do you have installed?
I don't think I wanna tell you that just because there's so many.
That's what I'm saying. Like, the bar is
Yeah.
really high. But,
The
like,
bar is really high.
this is how we think about things. It's like there's so much out there. Oh, my Kindle? But I guess to your point, what we really my pharmacy, what we really look for
Yeah.
is
My
around, like,
health.
what becomes habitual? Like, what can become truly integrated in your life?
Do you think then from that point that I know that there's been a couple articles circulating around this, but do you think on the point of social media that a new social media platform on this wave of mobile, do you think that is that one that truly, takes off and um becomes widespread? Do you think that is going to happen?
Of course. I mean, sometimes things just emerge again because other things get stale, or you wanna sometimes, like, great brands, and I would consider social media one of these, is that a brand says more about you um, than the title itself. Like, I wanna invoke something about myself, and that's why I use certain brands, and so I think, you always see these trends where people use certain things and then they move on to other things or they start to fill different needs. Um, and then maybe they go back to the original brands or they have like there's this always like push and pull. Like here's an example. Um, I get a lot of heat from my friends because I still use Facebook sometimes or like Meta, and they're like, "Meta's for like you're oh my god, Shmeen, how old are you? Like it's for boomers now." And people are saying like that's the reality of what people are saying. Although it's it's an enduring brand, they're doing a ton of interesting things and innovative things, but nothing has changed about Meta, but like now there's this like perceived for a while there was like LinkedIn is your professional and, Instagram's your selfies and Snapchat is for like the young kids and Meta's for like the boomers. So I think there's always going to be room for something new because people are going to need something to help identify themselves or like create community with someone else. But if you wanted to ask me, like, what do I think it'll be and what shape it'll take and what will catalyze it, I have no idea, or else I'd already be an investor in it.
In terms of AI mean, I know that you've made some AI investments, if I'm not mistaken, but for you to become interested in AI, let's say like an AI company, what actually kind of has to happen in terms of like the use case for you to become interested?
So we joke that, AI for us is like saying you use the internet, right? So it's like Brian jokes, he's like, if you're not using AI, like, what are you doing? So I think at least for us, there's nothing in terms of the innovative picks and shovels on building this in AI that would make us interested, either because we don't feel like a 500K check is going to do anything for anyone, or we just don't have the technical knowledge to really vet how X is different than Y. Otherwise, I mean, I think again, it's if like we look at a billion e-commerce companies and some of them do well and others don't, and it's really but no one comes to us and says like, "I'm building a business where you can shop on a computer." And we're like, "Wow, you can buy something
Yeah,
online?" Like,
yeah.
that doesn't
You're using it. You're just using it
yeah, it's
as
like
part of the product. Yeah.
you're making it smart because your user interface is great or like you've integrated well with other platforms, so you have an interesting sales and distribution advantage. So, I don't hate on AI in the sense that I think that it is part of the future, but I don't necessarily hear it as a standalone term and think, "Oh, that's enough." Like, at that point, it's just looking at what you traditionally look at a company, the founder, the product, how they think about their consumer, do they have a sales and distribution advantage, like, how are you using AI to be an accelerant to your business or to make something that wasn't possible before possible now or to better serve your customer or give them a more delightful experience or make them, maybe your customer doesn't even know you're using AI, but they think you have the best customer service of any company they've ever dealt with. Like that's the kind of stuff that's interesting for us, not necessarily AI as a standalone technical term.
That's a really good point. That's a really good point. If it's okay, can we do a quick fire round?
Okay.
Cool.
I'm not very good at these.
All right. What is the biggest consumer trend to watch out this year for, do you think?
We're so founder driven. I don't know. Anything I think that we look a lot at like the downstream effects of like Ozempic and all of that.
Oh, okay.
Is it gonna
Okay.
change things? How you date, how you drink, how you eat? Do you need special meal plans? Do you need more supplements because of it? Are you going to the gym more? Are you going to the gym less? Are people getting divorced more because one of you's like, you know, not you don't like meals out anymore, or you don't like the taste of alcohol, and the other one wants to, you know, live it up. I think there's
Lifestyle
like a lot
changes
happening.
with Ozempic. Yeah, no, that's a great point. Also, does that mean that you have to supplement it with, more protein, for example, to make sure you still have, adequate protein levels. And yeah, I've been thinking about how does Ozempic as well change the grocery store just in general. Like what actual categories won't do as well if, for example, mass, people that who are overweight, if they actually do subscribe to Ozempic or have prescriptions to it, how would that actually
I
change
think
like the
that, like,
grocery
one
store?
thing that's interesting is and then I think there are, like, counterintuitive points, right, to your point. So, are you going to eat less pastries because, you're hunger controlled, and so you're not gonna eat, things that are bad for you? Or are you gonna eat more pastries because you can portion control now, and so you can have treats that you love and know that you can only have a couple bites of them? Is this good
Y-
or bad for donuts?
Yeah, no, that's a really good thought. I would have thought it would have been bad just from face value. Would have been bad for donuts, but you do make a good point in that can you actually do a much better job in terms of portion controlling yourself with
Yeah, I mean,
Ozempic?
if you know that you can control your appetite and you want a treat and you can have a few bites of a donut, then you might be able to actually enjoy certain treats the way that, you know, other countries make fun of us for, where they're like, we have desserts and we have pastries and we're not like restrictive because we portion control. So I'm curious. I don't know the stat, by the way. So I'm curious, but I do think there will be changes from things like that.
Yeah, no, that's a fair point. That's a fair point. What consumer category are you most bearish on?
VR, I guess.
VR. Okay. Okay.
I don't know. I mean, I think great founders always know how to crack through the noise, which is why we're founder driven, not category driven. So many of our companies are not innovative categories. When you think about it's a beauty brand, it's a dog food brand, it's a supplements brand, but the founders make it innovative in a certain way. And so that's why I'm so bad at these quick fire questions because I'm like, well, it depends. I don't know if it's the lawyer in me too, where I'm like, I don't want to say something so black and white when I know there's a world of gray out there.
That's a fair point. That's a fair point. What's your favorite consumer product innovation from the past 5 years?
Ozempic?
Ozempic. Okay.
Yeah, I mean, I don't know. I think it's a huge one. No, it's one we've just talked about.
Yeah.
Um, Consumer product innovation. Now I feel old because I wanna say ride sharing, and I feel like that was 20 years ago. So, what happened in the past from 2020 to now? What do we
I actually think on the on the ride sharing front, um, I think Waymo is like unbelievable.
Yeah,
Just from like the next age. I think that that is just incredible in terms of about innovation.
yeah. I mean, a lot of people joke about the freedom of not having to make small talk, but the ability to control your own music is really liberating. And the volume.
Yeah.
Yeah, alright, I'll steal your answer, Waymo.
Final final question. What's one book that's inspired you personally and one book that's inspired you professionally?
I think both. One of my favorite books as a child was The Little Prince, and it has inspired me both personally and professionally because it has 2 really strong themes, one of which is don't diminish simplicity. Um, we lose I mean, brief overview, it's about this little prince, and he goes to this new planet, and he wants to take care of his rose. He has this, like, beautiful it's a children's book. He has, like, this little rose, and he goes to this other planet, and he realizes there are, like, millions of roses. He thought he had this, like, one unique treasured thing, and then realizes there are all these others, and then kind of learns that there's meaning in the one he has because he has chosen for it to be significant to him, and he has a connection to it. He doesn't have a connection to all these other roses. And I think personally and professionally, whether you're thinking about a spouse or, like, thinking about a consumer brand, one of the big themes is that as adults, we overcomplicate everything, or we try to diminish curiosity and creativity and whimsy. And so, for example, in the book, someone draws a picture of a hat, And the adult says, of course, that's a hat. And he says, no, that's a snake eating an elephant. And I just like love that idea to just remember to continue thinking outside the box. And also, um, that even if it's a children's book, it has so much depth in it that it's okay to not necessarily recommend something that's, um, academically hard to sift through. There's a reason why it's been an enduring book. But also on the line, like whether professionally through like marriage or a consumer brand, this idea of, there's a lot of everything, but things have meaning to you because they have meaning to you. And like this like kinship he has with this one rose, even though there are a million other roses, and the realization that no, this one is special to you is just kind of this like enduring idea that I think we go through in life, whether you think about commitment or whether you think about, well, can someone build something that someone connects to when there's a million other X products? And for us, like we're not investing in just products, we're investing in, an emotional connection.
Totally, totally, totally. I no, no, that makes a ton of sense, and I really appreciate you sharing that. I don't think we've had anyone else share the Little Prince before, so you are certainly original, Shamin. Um,
Yeah, I feel
uh,
like I should have said something like,
no,
I don't
no,
know.
that's perfect. That's
The
perfect.
intelligent investor. But I think there's, like, a lot to be learned about, like, just human principles and thinking, even from, like, a children's book. Especially now that I have my own children, sometimes, my kids are asking questions like, "What is God?" and, like, "Why do we die?" And it's really incredible to be able to learn about it from the level, I don't know, like, everyone talks about first principles thinking, and there's nothing more first principles than a children's book, right? It's like, this is how basic you need to be to explain these grandiose topics, and it's, like, really been valuable to kind of go through life with that where you're like, "Why am I overcomplicating this? Like, let me just pare it back." And I think for consumers as well, something I mentioned at the beginning, so maybe this kinda, like, bookends well, is that, founders who also know how to deliver a message simply and they're not overcomplicating it, because there's only so much our mind can absorb or connect with.
Yeah, no, for sure. No, that's a great, the awesome example. I haven't read The Little Prince, but now I definitely need to add it to my reading list.
Yeah, read it, tell me what you think.
We'll do. We'll certainly do. Shamin, thank you so much for your time. This has been a lot of fun.
Thank you, and thank you for taking the time.
And that's it. Shamin, thanks so much for coming on the show. Highbeam, thank you so much for sponsoring this episode. And if you're loving the show, please hit that like button and subscribe on whichever platform you're listening on. And if you really, really like the show, check out theconsumervc.com and sign up to the newsletter. I send a weekly email of all the latest news in consumer that's happening. Thank you for listening.